Ever feel like getting a mortgage is a total mystery? You send in this giant stack of papers, right? And then you just hope for the best? Well, what if I told you that you could know exactly what the lender is looking for? Today, we're going to crack the code on how FHA loans actually get approved. So yeah, what is the secret sauce? What are lenders actually looking for when they look at your application? Well, here's the thing. It's not some big secret. It's a system, a process with a very clear set of rules. And once you know those rules, the whole game changes. You can walk into this thing with a ton of confidence. Okay, so where are these rules written down? Is there some secret lender's manual? Actually, yes. Every single FHA lender has to follow one master guide. It's called the HUD Handbook 4000.1. Think of it as the official playbook for FHA loans. And today, we're going to flip through its most important pages. You know, for all its complexity, this whole underwriting thing really just comes down to two main things, two pillars. First, they look at you, the person asking for the loan. And second, they look at the house you want to buy. That's it. Simple, right? So let's dive into that first pillar, you, the borrower. All right, pillar one. This is all about your financial story. The lender's main job here is to figure out one simple thing. Are you a safe bet? Can you be counted on to pay back this loan? And to answer that, they zoom in on three really specific areas. In the industry, they call these the 3 C's. First up is creditworthiness. Basically, what's your track record? Do you pay your bills on time? Next is capacity. This is all about your income versus your debts. Can you actually afford this new mortgage payment every month? And finally, capital. This is the money you've got saved up for the down payment and all those closing costs. Now, let's talk about that capacity piece for a second. When a lender looks at your income, they're looking for what they call effective income. And no, that's not just what's on your paycheck. The key words here are verifiable and likely to continue. So if you make money from, say, investments, they're going to look at your tax returns for a few years to see a steady pattern. If you've been losing money on those investments, that could actually count against you. It's all about stability. And what about capital? You know, the money for your down payment. Well, it's a lot more than just what's sitting in your savings account. The official handbook actually lists some sources that might surprise you. I mean, sure, stocks and bonds, that makes sense. But did you know funds from private savings clubs can count? Or even the equity from another property that you're trading to the seller as part of the deal? Pretty interesting stuff. Okay, so let's say your finances are rock solid. You've got the 3 C's all lined up. You're done, right? Not so fast. That's only half the story. Now we have to talk about pillar number 2, the property. Because the house you want to buy, it has to pass its own inspection, its own big test. And here's why this is so important. Remember, the lender isn't just giving you a huge pile of cash out of the goodness of their heart. The loan is secured by the house itself. That house is the collateral. So they need to be 100% sure that the property is a good, solid investment, just in case things go south. So how do they check? An FHA appraiser comes in, and their job is to hunt for specific red flags that are spelled out in the handbook. And we're not talking about chipped paint here. We're talking about major safety and structural problems. Things like standing water pooling against the foundation, a super damp basement, or busted electrical or plumbing. These are the big ones, the absolute deal breakers, unless they get fixed before you close. But wait a minute. What if you want a house with those red flags? What if you're specifically looking for a fixer-upper you can turn into your dream home? Well, believe it or not, the FHA Playbook has a chapter just for that. This is where a really cool program called the FHA 203K Rehabilitation Loan comes into play. It's an amazing tool designed for one specific purpose, to let you buy a house and get the money to fix it up, all rolled into one single mortgage. And the really powerful thing about the 203K is just how much you can wrap into that loan. It's not just for lumber and new appliances. The handbook says you can also finance all those other costs you might not think about. You know, the cost of an architect, getting the right permits, all the inspection fees during construction. You can even roll in title update fees. It's the whole shebang. So let's step back for a second. When you look at all these rules about your income, about the property's condition, it's easy to think they're just a bunch of hoops to jump through. But that's not really what they are. They're safeguards, really, for everyone involved. In fact, there's a quote right in the handbook that kind of sums up the entire philosophy. It says, "The goal is to find a price where the buyer and seller, each acting prudently, knowledgeably." And that's it, right there. The whole point of all these rules is to make sure the deal is fair, the price makes sense, and the property is safe. It protects you, and it protects the lender. And really, that's what I want you to take away from all this. Getting a home loan can feel super intimidating, I get it, but it's not a secret club with rules you can't understand. Once you know the playbook that the lenders themselves are using, you're not just some person hoping for an approval. You become an active, informed player in your own journey to buying a home. Because when you know how the system works, you can get your finances in order, you can pick the right property, and you can walk that path to homeownership with some real confidence. So, now that you've had a peek at the playbook, you tell me, are you ready to get in the game?